I went on CNBC India again this week to discuss gold and silver markets with Manisha Gupta. We'll cover that discussion in the second half of this week's Bullion market update. But first, we need to cover other goings-on. This afternoon, the USA, with President Donald Trump, and Russia, with President Vladimir Putin, held a summit in Anchorage, Alaska, to discuss a potential end to the Russia-Ukraine war. The near 3-hour meeting served more as groundwork for future negotiations than a decisive resolution, leaving the Russia-Ukraine conflict's trajectory uncertain in the near term. What actually came of the meeting, in other words, is about this incoherent.
Press. Thank you, press. Thank you, press. Thank you, press. Thank you, press. Let's go. Thank you, press. Thank you, press. Thank you, press. Let's go. Come on, guys. Come on, guys. Let's go. Let's go. Thank you, press. Let's go.
Thank you, press. Thank you, press. Thank you.
To start this week, Monday, August 11th, President Trump confirmed imported gold bullion will not be tariffed on his social media. Speaking of tariff income, apparently the U.S. brought in $28 billion last month, July 2025, with total tax receipts of $338 billion versus an estimated $630 billion spent in the month alone. A growth of the U.S. deficit of nearly $290 billion in just last month, July. We are seeing more headlines of underscoring a broader shift in U.S. policy toward industrial support in critical sectors like advanced chip manufacturing on domestic soil, as opposed to stranglehold over in Taiwan, diverging from our nation's alleged free market principles. More troubling U.S. House data from the National Association of Realtors. Apparently, elderly U.S. home buyers aged 70 years and older outnumber buyers under 35 years old. 70% of current U.S. house buyers are aged 45 years and older. Continuing on U.S. housing data, I have new long-term charts illustrating median U.S. house prices going all the way back to the London gold price rigging pool of the late 1960s to now in 2025. A somewhat recent price rollover for the middle house price sold in the USA has fallen to just over $401,000. But when measured by the sum of gold required to buy a median U.S. price house over the last more than 60 years, the price inflation fog lifts to show a distinctive pattern going all the way back to when then President Nixon defaulted on the U.S. dollar's final formal ties to gold nearly 54 years ago today, August 15, 1971. Within less than a decade that followed that action, gold in U.S. median house buying power nearly tenfolded. In other words, the median U.S. house that once cost nearly 700 ounces of gold in the early 70s, late 60s, well, to buy a median house by early 1980, it was near 70 ounces of gold. You can see in the 21st century, we appear to be repeating a similar pattern on this chart. We seem to be on the cusp of falling below the low levels hit during the 2011 gold price record runs. Measuring median U.S. house prices by silver, the story is similar, but slower moving, at least for now. If U.S. median homes stayed priced flat around $400,000, let's say, well, the price of silver would have to more than double, or go near $80 an ounce spot, in order to return to the relatively low levels reached in the early 2011 silver price run. In probably the most important gold-related financial media piece this week, the former director of Argur Heraeus wrote an op-ed in the Financial Times arguing that the London Bullion Market Association, often known by the acronym LBMA, and the London Precious Metals Clearing Limited, both private trade group and private bank-run consortiums, remain too opaque and under-regulated, arguing that the Bank for International Settlements, or the BIS, should step in to oversee core elements of gold market infrastructure. He cited the recent European Central Bank's warning that under extreme events, the current global gold market system poses financial stability risks. The ECB has publicly stated, quote, vulnerabilities have arisen because commodity markets tend to be concentrated among a few large firms, often involve leverage, and have a high degree of opacity, deriving from the use of OTC, over-the-counter, derivatives. Disruptions in the physical gold market could increase the risk of a squeeze. In an example of this opacity in real-time misleading charts and data, Bloomberg published the following data set last week, misleading its readers by stating that, quote, 300 billion of gold changes hands every day. It would have been high 90 percentile more accurate to instead state 300 billion of gold derivatives trade every day. The world gold market has about 252 trading days per year. That's about 2.1 billion per day in newly mined and recycled gold supply coming to the world's physical markets. The vast majority of some estimated 80,000 tons of gold held as stores of value between large bullion bar formats with central banks and/or in smaller gold bars and coins held by investors worldwide, those holdings are nearly never for sale. What we have in gold, and often more so too in silver, is mainly a digital derivative proxy price discovery system. When the world needs the real things, bullion and size, we'll have a problem that neither the LBMA or the BIS, for instance, has any chance of quelling quickly. The Washington Post published an investigative piece this week about illegal Chinese gold mines spanning 3 continents, now between South America, Africa, and Southeast Asia. China's often illegal mining various jurisdictions, often by bribing local authorities. This has been going on for over a decade in varying parts of the world, even in the Amazon jungle. This is the new normal now, Western man. China's insatiable demand for gold and other commodities shows next to no signs of slowing down. We'll be right back.
Hello, this is James Anderson on behalf of SD Bullion. Smash the like button if you enjoy these bullion market updates.
And be sure to visit sdbullion.com/sweepstakes to enter our free 500-ounce silver coin giveaway.
The worst day on Wall Street since the crash of 1987.
We're now down 43%.
This could be the most serious recession in decades.
Protect your retirement with gold and silver IRAs. Learn more at sdbullion.com/IRA.
Silver and gold prices were a mix of flat to slightly down this week. The spot silver price closed at $37.97 an ounce bid, and the spot gold price ended the week at $3,336 an ounce bid. The spot gold silver ratio ended the week down a touch at 87. This past Tuesday morning, I spoke with Manisha Gupta of CNBC TV 18 in India for about 16 minutes. It's a pretty wide-ranging discussion of gold and silver, not merely in the short, but the longer term. The best tactic in precious metals is buying and holding with the long view, and not trading in or out all that often. We can only guess where the markets might swing in the short term. Towards the end of the segment, I made sure to remind Indian investors out there to go out, buy, and own the real things outright. Starting and establishing an ongoing bullion position is the best general route for most investors in my experience. Have a watch.
Welcome back. You're with us at the Big C, and joining us now is SD Bullion's James Anderson. James, hi. Thank you so much for your time here. Well, gold has exhibited huge volatility in the last 1 week or so because of those tariffs on gold, a lot of miscommunication, clarification, or confusion. While it has seemed to be settling now, how have you read this chain of events?
Yeah, so it's important to understand kind of how we got there. So, like last Thursday in the morning, I saw that there was some news headlines regarding Switzerland and negotiations that they were doing with the United States, supposedly. And then later on in the day, last Thursday, you had the Financial Times report about an old U.S. Customs letter that was written by a guy named James Forkin, who, when you go and look at the details, the guy does tariffs on things like tennis shoes and aerospace and various things that come into the United States. There was a letter from July 31st of 2025, about a month and a half ago, where he had a misruling, essentially, telling someone, a lawyer who was asking on behalf of a bullion dealer for importing Pamp Sweets gold bars. And the guy misjudged it, basically, and said they'd basically be 39% over spot. I mean, anybody who works in the gold bullion industry understands in any size you work on basis points under 1% in terms of margins. So that literally would shut down half of the new refined and new mined gold in the world coming to the United States. So on its face, that was the most ridiculous report of all time. You could pretty much tell that wasn't going to last. And so Trump came out yesterday, obviously, and said that that was not going to be the case. And so, it's kind of calmed things down. But it's interesting when you looked at the price action, you saw the price run from, I think, the futures in the United States. They gapped up by like $120 over the spot price derived out of London, because traders were obviously assuming maybe that's going to be true, and we need to mark up the price of the gold that's sitting on shore in the United States in the futures warehouses. And so obviously we had a move that went extremely high very quickly and came back down when people came back to their senses. But what's interesting, I think, Manisha, is the fact that you can have misreports like that, and you can see how easy the gold price can be moved. And a lot of times that will be used into an advantage. You'll have a trader who will give false information to some reporter and then go in and lever up and take advantage of the reporter's naivete and the rest of the world's naivete. Most of the world doesn't understand how the gold and silver markets work or trade. So this is just one example, and it's fresh. It's only a few days old. So that's more or less what happened.
Well, absolutely, James. Because of misreporting, $120 of a move in gold is something that we can absolutely avoid. How are you looking at the gold prices moving from here on? Because the U.S.-China truce is now extended. The U.S.-Russia meeting is in focus. What is it that you would be watching out for?
So right now I'm looking more or less at the big picture. I am kind of holding, and I'd like to buy some gold, but I want to wait a little bit, I think. There's a 200-day moving average that just moved beyond $3,000 United States an ounce, right? And in every bullion bull market, what ends up happening is you kind of have a price that runs with a 200-day underneath it. But occasionally that price will bounce down to the 200-day. And my hope or contention, if I was going to buy gold in the next month, would be that perhaps there's peace in Ukraine and Russia announced this weekend. And that would be a nice excuse for the shorts in the gold market to come in and smash the price. And then say, and then people who don't understand the gold market will look and say, that's why the gold price is going down, because peace in Ukraine. And the truth of the matter is that's not why the gold price is where it's at. It has absolutely very little to do with Russia and Ukraine. It has a lot more to do with the underlying fundamentals of the global system of finance and fiat currencies, et cetera. And, central banks buying at record size, moving out of bonds and into bullion, et cetera, et cetera. But that would be a great excuse for it to go from 3,300, say. If it drops below that, you could literally see a quick shoot down and a test of the 32, 31, even 3,000. That's possible. You could see that in the next month. So I've got dry powder waiting, hoping that it does occur, because it's not going to last long, and we'll be back up toward these levels and probably beyond. I think by the end of the year you'll be beyond 3,500.
So what is your sense? I mean, as you said, there could be a lot of movement here, and if 3,300 breaks, 3,000 could perhaps be where the gold prices could stand up to by the end of this year. I mean, I know it's a short-term period. How would you look at gold performing?
So I don't really care, by the end of the year. To me, it's more of a long-term trade. When I think of gold and I think of silver, I don't think in terms of 6 months. I know there's a lot of people who, in their day job, they have to worry quarter to quarter, and I feel sorry for them, because a lot of times that's very difficult. It's much easier to put on trades that are multi-year, 2, 4, 5, 10 years out. And when I look at the trade for gold, I think in terms of long-term. I look at big, large commodity charts that last for hundreds of years, and I think in terms of history. And so when I look at gold compared to the S&P 500 in the United States, for instance, gold in the stock market, over the last 100 years of our financial history, about 1-to-1 has been the norm. The S&P 500 is like 6,400 right now. And for it to go back to 1-to-1 in terms of parity, that's going to be going back to the norm, the mean in history. And it happened in 2011, and it went beyond 1-to-1, which is something that happened even, 14 years ago. So for that to happen again won't surprise me. For it to gold price go beyond the nominal S&P 500 by, say, 2030s, that would not surprise me whatsoever. So that's the kind of long-term view I kind of keep. I don't really think in terms of, if gold's not at 4,000 by December, this has been a failed trade. That's not how you should be thinking about it. You should have a core position in bullion that you just don't touch.
That I would agree with, James. But did you say $6,500 an ounce by 2030 in sense of gold?
Yeah, totally possible, because the S&P 500 right now is roughly 6,400, and you have gold that's sitting at 3,300. So it's almost twice the price of gold. And if you look at long-term historical chart, for gold in the S&P to be 1-to-1, that's normal. In 2011, it went below 1-to-1. It was like literally like 1 ounce of gold would get you more than the S&P 500 for a good stint there in 2011. So 2011 was a joke. Like that was a pipsqueak bull market. We're going into the biggest bull market the world's ever seen. So for it to go back to 1-to-1 and then beyond that, it's totally normal. I am very convinced that by 2030 you would see it S&P 500 and gold by 1-to-1 by then.
All right, that's very, very interesting, and we'll keep an eye on that one. But James, also coming on silver, and The narrative clearly has been about a lot of bullishness in silver. The industrial demand seems to be picking up. There are no new projects that we've seen in last many years. And if there are more mines than come in, it would take a decade at least for the new silver to come in then. How are you looking at silver, one, demand, and the second, prices as we move ahead from here?
It has tightened the situation, obviously. You've been in a deficit now for 5 years running, and these are pretty large deficits. So it's pulling away a lot of the excess silver from holders and from places where are kind of weaker hands. In terms of, silver, 70% or so is a byproduct of major other miners. So they can turn it up and crank out some more silver, possibly, if they get more capitalized in the years to come. So that is something to consider. But ultimately, we have a situation where industrial demand is taking up right now 81% of new line mined silver, right? So that leaves only 19% left for things like silverware and for investment purposes. And I think people don't really understand how tiny silver is in terms of the global financial markets, and the fact that Western capital has barely come into the sector. I mean, they've come into gold a little bit in silver, but it's been nothing compared to what eventually will come into it. The problem is when a lot of capital comes into it, it's just not going to be able to handle it. Like, the inventory will be cleared out, and you basically will have any bullion that you get at reasonable timeframes will be months out, and it'll be priced well above spot. I mean, that's happened multiple times in my career. It happened in the global financial crisis in 2008. It happened in Silicon Valley bank runs in 2023. I expect it's going to something like that is going to happen again. And there'll be a situation where you'll have spot price saying something, but on the investment grade products, on the tiny products, it'll be much, much different. It'll be much harder to get. And that's generally, by that time, you've already wanted to have a position. You want to be ahead of that. You don't want to be late and get stuck outside looking in.
James, coming on the percentages then, when you say that 81% industrial demand, 19% is just about silverware. So when it comes to silver industrial demand vis-a-vis silver investment demand, how do you see money allocations going forward?
So industrial demand has been growing precipitously for the last 5 years or so. And I don't think people understand how much it's been growing between solar demand and all the other inputs that we use silver in terms of automobiles and other things. We couldn't have this interview, Manisha, if we didn't have silver in our world. It's flat out, we have to have it. Without silver, you're back in the Stone Ages. You've got to have it in terms of all the things that we like in terms of our modern world. And so, the industrial demand, that's not going away. The only way someone could argue it's going away is if we go back into some type of deflationary depression, World War scenario, which I personally don't believe is going down. I don't think that's how the future is coming. I think what you're going to end up seeing is a lot more emerging markets continue to develop, get larger. There's going to be more demand for silver, pushing on it for a long time. And you're going to have a situation where that industrial demand is going to continue to stay robust. And then at some point, the store of value investment flow for silver is going to come chasing simultaneously. And that's just going to be rocket fuel in terms of price and in terms of getting it. There's going to be shortages. It'll be very difficult for a lot of industrial players to get their hands on it. What I'm hearing rumors is it's basically a lot of industrial players are going directly to mines, to refiners to get, guaranteed supply. They're basically going to be buying a certain threshold per month and guaranteeing that type of revenue coming through the streams for those companies. And so they're jumping over the different lines to make sure that they get what they need. And so that is common. You're hearing that happening all the way from China through now in the Western world. You hear that happening in desks. At trade shows, even you hear that happening even in the United States. So this idea that silver is somehow in like massive supply and there's silver everywhere, it's just not true. It's a very tight market, and it doesn't take much further to make it a real problem.
Oh, wow. That's very, very interesting. That industry is going to mines directly for an ensured supply there. So, James, with that kind of a scenario where we are looking at shortages going forward and the demand very, very strong, what is your sense then on a long-term silver price view from here?
I mean, I'll do you short term. I mean, the $40 an ounce number, we have to get over that in the United States. But on the longer term, what I do is I look at, for instance, before this conversation, I made sure to look at Indian prices, right? So if I was an Indian and I'm looking at long-term charts in India, I would look at gold, right? Gold has already tripled almost from its breakout, from its old highs in like 2011. So it's more or less threefold in nominal price, whereas silver has barely broken out. It's 50% above its 2011 highs. When you look at those two charts together, silver in India has the double to even match what gold has done to this point, since the 2020 breakout roughly. But that's when I think of the rupee, that's a currency that obviously is devalued historically, and so people there are kind of used to that. But I'm going to talk to you about laggard currencies like the Swiss franc and the Japanese yen. Like, for instance, both of those currencies, gold has taken off. It's gone well beyond its old 2011 situation. It's well beyond its old 1980 high. But silver in both those markets is well below its nominal 1980 high still, right? And so if you have a situation where silver simply matches what gold has already done in both those markets to this day, you have a situation where silver has the multiple by factor of 5 in Swiss francs and in Japanese yen. All right. So I know people like to think, the rupee, I'll hold a different currency than that. And Swiss franc is like a safe haven currency. But the truth is, the Swiss franc was it was defined by being silver. Like in 1850 when it started, it was, I think, 5 grams, 90% silver. The yen was like 25 grams of silver in 1871. And now they're going to have a situation where both those fiat currencies are going to get lapped multiple times by silver in the coming 5-10 years. So these charts are long form, but I mean, in terms of the short term, silver could be running to 50, the nominal high, by the end of this year if things go spellingly well for silver. But next year, worst case, if we go through some type of deflationary issue, the authorities are just going to print more currency and inject more currency. So by 2027, for it to go beyond 50 is totally reasonable. And, once you get beyond that nominal 50, it could go to 70, 80 quickly and then probably pull back, and 50 will then become support. You'll basically have maybe a year or two where it kind of consolidates. And that's not even yet the mania phase. The mania phase in the United States calls for triple digits silver, and it's pretty easy to do the math on it. I mean, think about it. Your 1980 high of gold was around 850. I mean, that's more or less quadrupled by now. It's 4 times. And where's silver? Silver's still below its 50 nominal, right? I mean, think about it. Silver's at $40, right? Roughly. Multiply that by 4. So there you are, 160 an ounce, just to match what gold's already done. And that's just now. Like we're talking about the future. We have record debt, record unfunded liabilities that we got to write off in terms of devaluing our currency. So this concept that silver is going to stay calm and placid and 50 is like some big number. 50 is a joke. In the long term, you're going triple digits silver, and it's going to be probably going into next decade, it's going to get even sillier. So, by that time, you'll want to pare down some of your holdings. But at this moment, this is not the time. This is the moment you need to get out and you need to actually go and buy your little silver bars. If you have real money, you need to go out and get bigger silver bars and do it in size and hold with 2 to 5 year time frame, not like a 2 and 5 month time frame. I see, Manisha, I see that there's a lot of ETF investors, and I'm happy to see, 65 million ounces roughly of inflows into Indian silver ETFs. But you got to remember, if you have an ETF holding, that's an unsecured fund. You don't actually own those metals. My suggestion is you make sure you go out and own the real thing and buy it, hold it with a long view.
Wow, James, you're sitting with those big bars of silver there, and I get your point when you say that the silver has to be bought for 2 to 5 years of buying frame, and I absolutely get your prices. $50 an ounce by 2027, and then a 70 and an 80 and a triple digit as well. So silver is clearly the place to be, and as James tells us, physical buying is always better there. Thank you so much for your time with us here. Appreciate it. But with that, it's all the time that we have on this episode of The Big C. Thank you for watching.
Heads up to all you Commander Series coin collectors out there. The new limited mintage 5-ounce Caesar coin is on sale this weekend at SD Bullion, along with other low premium bullion offerings. That will be all for this week's SD Bullion Market Update. And as always, to you out there, take great care of yourselves and those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.